Okay, guys, today we have on Rory from Cleanspark. A little bit different than maybe what I'm normally doing. And this is Bitcoin mining. And I haven't really ever had a Bitcoin miner on before, or anybody who works at a Bitcoin miner. So this will be a fantastic conversation. Rory, welcome. Where do you work and what do you do?
So I am in scenic northwest Connecticut. About a couple hours outside of New York City. So I exist in the New York, we actually like to think we exist just outside of the kind of New York metropolitan kind of gravitational pull, but definitely in that part of the world. My background is I spent 8 years at a global macro fund called Discovery Capital. Discovery Capital was started by a portfolio manager named Rob Citrone. Rob Citrone started the emerging markets desk at Fidelity in 1993, back when what we would probably call frontier markets today, were what they were kind of calling emerging markets then. He then went to Tiger Management. And there's like three main investors that like everybody knows in kind of descending order. Like obviously there's the Warren Buffetts of the world and the Charlie Mungers, and then there's the George Soroses, and then there's a guy named Julian Robertson, who was really kind of one of George Soros's kind of real contemporaries at that time. It was really Soros Management and Tiger Management, which started kind of the macro investing kind of trend and asset class, if you will, back in kind of in the 90s. So Rob was at Tiger Management, I believe, from 95 to 99. I think saw kind of an Argentinian debt crisis, saw a Mexican kind of the Brady bonds, Mexican debt crisis. So that's really the background that he brought to Discovery, which he started in 1999. Now, to be fair, I started much later. I joined in 2011. I was there till leaving in 2019. But that was really the DNA. So it's a global macro fund. The investing landscape had really changed at that point. Things were moving more to this kind of blast on, blast off, post GFC, liquidity driven, kind of big tech and buyback driven market. But the DNA was really emerging markets. So that was really a fantastic way to start my career, because started on the trading desk there. So really got a front row seat to the glow ups and blow ups of the emerging market complex with this kind of macro investing kind of background. And that was really a great experience. I left in 2019 for a number of different reasons. I was always really I got caught by bit by the Bitcoin bug in 2013. And like many enterprising, I think, young people on the street thought that a growing asset class and an interesting technology, everybody would be super excited and really want to get involved. And, I think it was like a lot of people kind of have that story where it was really swimming upstream to get people on sides with this idea that this was going to be something interesting. First it was, it's too small for us to really look at. There's not enough liquidity. There's not enough alpha really in it. And then it's too weird, and then it's too dark web, and then it's too whatever. And so, but I could never get over it. So I left in 2019 really with the idea that the world was changing. When you're a global macro investor, you are really sitting all the way at the bottom and waiting for a whole lot of other decisions to happen, right? You're waiting for policy to get set at the White House. You're waiting for the economy to shift. You're waiting for the company to report the quarter. You're waiting for the analyst to put the trade to recommend the trade. You're waiting for the portfolio manager to put the trade on, and then you're waiting for earnings to come out. And so you're really sitting all the way at the bottom of that stack. And I was really interested in kind of taking these financial principles and going to this nascent, emerging monetary alternative, and building something that you could both take these financial principles, but you could also build this new space. So that's I like to say a long story short, but it's a long story long. I'll just try not to make it any longer.
Yeah, no. Okay. I'm going to make you make it a little bit longer just a tad bit more context, which is you were at Griid, correct? And Griid was then acquired by Cleanspark. So what was your role at Griid, and what was Griid actually, first of all, and then what was your role there, and then what did you transition to at Cleanspark? I'll let you ramble because that was 3 questions.
Yeah, and again, like I said, I am nothing if not a rambler, so I appreciate you. I appreciate you letting me do that. So yeah, so when I left in 2019, I went and did a coding boot camp with the idea that so I did my CFA when I was at Discovery. And I really thought I was going to stay in the TradFi system, and I really thought I wanted to kind of bring Bitcoin into the TradFi system and really kind of get involved. It became clear to me that the most leverage so I did my CFA. You learn 3 sheets analysis. You learn, to read a balance sheet, an income statement, and a cash flow statement. It became clear to me in that 2011 to 2019 period, like a lot of things happened, right? One is Silicon Valley went bananas, 2.0, right? And you had the creator economy come on. You had the communications technology revolution. You had all of these different things start to happen where we were really stuck. I was at an awesome fund and I had a great seat, but it was a little bit like I almost got there too early in my career because I'd seen a lot of people that had been, they were at the Sovereign Wealth Fund in Oslo, and then they were trading local rates in India. And then Rob is great, knows for talent and a nose for people, and he doesn't care if you're coming from the highest to the high or the lowest to the low. If you have the experience and you have the attitude, he's going to pick you up. But he'd kind of amassed these kind of people from all these different walks of life. I got very lucky to get there early in my career, and I said to myself, I want to be a part of kind of this growing new asset class. I want to build something. Maybe I'll come back one day, but I need to, like a young man has to go sow his wild oats, right? And so you got to go put your mark on the world. So I left that, did a coding boot camp with the idea that you had this communications technology revolution, you had this coding revolution, you had this creator economy revolution, and they kind of build your own brand, roll your own thing, cloud services, make startups cheap, right? You can go do it on your own and maybe go figure out that mark. And lastly, which that everything is becoming a technology company. So you can read a balance sheet, you can read an income statement, you can read a cash flow statement, but you also need to, I might not be like backroom coder guy, but I need to understand the inputs and outputs at the computer, not in a Zoolander like I'm banging it on the top of the desk way, right? So that was all kind of that thought process. Went and did coding boot camp, popped out in 2019, was building a P2P exchange. We were really trying to use like RBTC, so Rootstock was the idea, was that you kind of had an early kind of BTC side chain, and you wanted to do these. Now I'm blanking out on the name, but it's basically these instantaneous
atomic swaps.
Atomic swaps. There you go. Thank you. Should have hired you.
No.
Do these atomic swaps between ETH and RBTC. So I was always really BTC focused, right? Like I wanted to work in the BTC space, but at the time, a lot of the degrees of freedom, particularly for I'd had this great career, not to pat myself, but it was, something my parents could understand. And I'm starting this entirely new thing and nobody knows who I am. I have no network, whatever. So some of those opportunities were a little bit more kind of hybrid opportunities. So did that for about 6 months. Wasn't the right fit. I started at a capital markets on Ethereum startup called X Token, where they were basically doing wrappers on like OV and a couple other kind of the yield bearing tokens. And that grew into kind of a capital markets platform. My heart was always in Bitcoin. And I'm a maximalist. I'm not a maximalist, and I try not to be. Certainly not kind of coming from what has really kind of moved on in the space, but things got a little bit dicey there for a couple of years. But I'm here for free, decentralized, anti-authoritarian, censorship-resistant freedom money, right?
Oh, yeah.
And so culture, art, music, degrees of freedom, all that's well and good. It's just not where my heart is. So, I talked to my friend Harry Sudak. I met him at an Unchained event in 2020. It was February 20th, 2020, and I will always remember the day, not because it was just after Valentine's Day, and I love that guy, but because it was the very last time that I went out before the world shut down for COVID. So I met him February 2020, started working at Tassin, started working at X Token. We just talked. We talked sometimes every week, sometimes every month. And we talked for a couple years. And it was summer of 2021. I'd had my first kid. I had my girl. She just turned 4. And, we were kind of peaking in that bull market in 2021, but things were getting a little frothy and a little crazy. And they were getting a little bit away from what I felt like was the mission that I was on. And so I said to him, I'm looking at this, I'm looking at that, like I'm thinking about making a move. Market was very hot. And, it was like, come do this NFT project, come do this, come do that.
Right.
And he's like, hey man, like make a move. Don't make that move, right? Like we're about to go hyperscale this bit. Like we've spent 2 years in the trenches building out a power pipeline. We've built the capital markets relationship. They just signed this kind of major debt agreement. They were looking at kind of at de-SPACing to go public. He's like, you have this TradFi background, you have this computer science native background, and your heart's in Bitcoin. Like, come help me think through what the next iteration of kind of capital markets, market intelligence is at Griid. Look, long story short, I think Griid had exactly the right idea. They tried to do it the right way, right? Which is that not to say that capital is easy, because it's certainly not, and as is evident, but it was like power's local, right? You have to go meet the utility, you have to talk to the city manager, you have to find the land, you have to deal with the neighbors. Like all of these things are really local, difficult to solve problems, and Griid had really solved that problem. But capital markets really froze up. At that time, it became a knife fight for kind of a year and a half. The cycle turned. Obviously, we had kind of the Terra Luna, Celsius, FTX, Three Arrows, you name it. And so things just got really tough for a couple of years. But I'm really proud of the team. It was a knife fight. We kept the business going, kept the business growing. And I really worked on market intelligence at that time. But it was really kind of looking at where's the opportunity set in the market? What's going on with ASIC pricing? Does it make more sense to kind of do a new gen model versus older model? What is how do things model out on kind of utilization? And it was less about this kind of like very offensive, like, we're on offense. How can we go kind of take territory versus defensive? Like, how do we kind of stay alive in this bear market? We popped out in 2024 and Bitcoin had started to recover. And the power markets had totally turned, right? So the AI HPC story had started to come along, and so we're in the Tennessee Valley, and Cleanspark was in Georgia and starting to move into Mississippi at that point. Cleanspark is America's Bitcoin miner. We at Griid had a very like American ethos. Like we fab our containers in Rutledge, Tennessee, right? We hire local, like we hire Bitcoiners. And so while we didn't call ourselves America's Bitcoin miner, that's how we felt. And so while to be clear, we were much smaller, but the geographic footprint really made a lot of sense. I think the DNAs of the companies were really similar in our gritty kind of American made, I think we were a little bit early, quite frankly, to that reindustrialization of the renaissance of the American manufacturing kind of idea. And so, we had a pipeline of power. Cleanspark had a lot of power, but they needed more. They had access to capital markets, and they had machines and an aggressive growth timeline. So I think the DNAs fit. I think the geographic footprints fit. I think the strategic kind of ideas fit. And I would like to say, 9-10 months in, that I think that the people have been a fit. I mean, the people that I work with at Cleanspark, it's just like a force multiplier. I'm so grateful to work with Gary, our CFO, Matt, our CEO, Taylor, our CTO, Scott, our COO. But I'm just naming C-suite, but I like working with Leighton and Sarah and David Ponton, and like it's just everybody is really there for the mission. And that's something that's really special and interesting. So that was kind of the transition through Griid. What we did at Griid, which was, I thought we were going to go on offense, turned a little bit into defense, but like a lot of things, you kind of end up in the right place at the right time because you were in the right sector and the right allocation, and you're open to the right idea, over the years. And sometimes it just takes 18 months longer than you expect.
You are, and I just read it and I clicked off of it, head of digital asset management at Cleanspark. Is that right? Did I remember that correctly?
Yes, I lead
Okay.
I lead our Bitcoin treasury management effort. So I'm the
Okay.
director of digital asset management. Not a big title guy, but I'm leading our kind of Bitcoin treasury
Okay. What does that
efforts.
mean? What does that mean in
Yeah, it's a
practice?
good question. Again, that's a very good question. It's a question that didn't have an answer, I think, when I joined. Because I think that there was a lot of ideas of what it could mean. Look, so we popped out. So we popped out in 2024. The deal got signed in June. We joined officially at the end of October. Show up November 1st. And it's like, what are we doing? So let's talk about what had changed, right? In the last cycle, everybody criticizes miners for not having hedged previously. In the last cycle, you were really not rewarded for that. And so I think that there was perhaps short-sighted but rational behavior in the industry, which was you get paid to YOLO in to $120 a terahash machines at the absolute top, drop $1 billion ATM, go crazy, and the organizations for the most part that followed that playbook were the ones that went down 85 or 90%. And the ones that didn't follow that playbook were the ones that went down 99 and ended up kind of merged into somebody else. And so
Yeah.
you had this interplay where the market was really rewarding it was everybody, the asset class was small in miners. The focus was small. There was no real street coverage, analyst coverage, institutional ownership, any of that. So it was really this kind of YOLO leverage retail play. And that was kind of, the 2021 cycle, right? As the asset class matured, Bitcoin went from $3,500 at the bottom of March, 7th, 2020. And I don't remember the date on that one, but I do remember staring very clearly at my screen, up to the 60, kind of 70Ks. And then now even higher in the last, since November, we've now gone up to 124, I guess, a couple of weeks ago. And really that bull market kind of started last November. So what changed? Well, one, IBIT, ETFs, obvious story. So you had a financialization of the asset class. So you had the financial products matured around the asset class. The size of the asset class changed. One, you mined more Bitcoin, so the market cap just gets higher because more kind of comes into it and the price goes up. So the asset class, you had institutional ownership come in. You have guys like Reggie Smith from JP Morgan who cover the space now. So you have institutional coverage, you have institutional ownership, you have a larger and more liquid asset class, and you have financial products around it, right? So I think that Cleanspark was really, what I appreciate about Cleanspark is they had always been counter-cyclical, which really fits my ethos. I was listening to your last episode with Felix, who I'm a big fan of, and it reminds me of a lot of our stories. He started as a value investor and then realized that it's a high velocity meme economy, and we all kind of gotta learn that in order to survive. But what I think is that Cleanspark had done a really good job before I got there of, they sold all of their Bitcoin really towards the top of the last cycle. They started adding again towards the bottom, and they'd grown in this counter-cyclical way. So when I got here, the idea was, okay, how can we take they've made some really good decisions over a couple cycles. How do we take that decision and do we systematize it into our business, right? Because it's really hard to get those right every single time. If you're going off of indicators and you're going off of this, but really you're going off of gut feels a little bit frothy, people I'm talking to, whatever. So with the increase of the size of the asset class, liquidity increase, maturation of financial products, it made sense to probably have somebody just look at this and kind of help full time. It's probably a little bit much for Gary, who's managing a multi-billion-dollar business now, multiple lines across 30 plus different sites and different things to also be the one with the hands on the buttons running the spot sales program, right? So there's a role for just kind of managing the spot sales. We're selling spot to cover our OPEX every month. But it's more than that. It's okay. We have a business that is triple levered to Bitcoin, right? We have our HODL. We have our ASICs, which are priced in Bitcoin, and then you theoretically have the growth multiple on the business, right? So you have, that's how I think about it. I think you have kind of the HODL, the BTC side. You have the machines, the ASICs. But that also counts for land, power, all these types of things. So that's kind of the middle stool. And then theoretically, you have a growth multiple on your business, where if your growth prospects are increasing, you get a higher multiple, and if you don't, so as the price of Bitcoin increases, our margins increase, our bottom line increases, and we're triple levered to this business. That puts you in a tough position to always get, kind of those counter-cyclical decisions right. It also puts you in a tough position to manage your cost of capital over a cycle and grow profitably and responsibly, right? And so what we're looking at, yes, please.
Sorry, let me just interrupt quickly so you can define this HODL strategy. So you're talking about your, selling on a monthly basis to cover OpEx, right? Like this is like sort of the standard understanding that most people have of Bitcoin miners. They mine some Bitcoin, they sell it, whatever the margin is their profit ostensibly. You guys have this HODL strategy. Break that down however you want. Like what you're holding some, but explain like the dynamics of that, how you think that through, just so people don't, you'd say HODL, people may not know what you're saying. So I just like give me a review of that.
So I think that there's three different like main buckets of HODL or no HODL, right? Which is that there's some miners, they say, hey, we're a commodity business purely.
Right.
We mine it, we sell it, we turn that into cash, we use that cash to pay salaries, OpEx, CapEx, whatever we need. Okay. I think there's the full HODL, which is, hey, not only are we going to hold what we mine, we're going to issue debt and we're going to issue equity and we're going to add more to it. So we're going to leverage up purely on the HODL side. I think we're, to me, we're strategic. We're not ideological. You've heard that a lot from us. And I think that we're a little bit of a hybrid model. We have 12,703 Bitcoin on the balance sheet. That's, $1.5 billion of Bitcoin. That's a nice chunk of Bitcoin. We're adding a little bit more every month. I think sometimes it will be more, sometimes it might be less, but, we're also looking at how do we be the most responsible stewards of capital that we can possibly be in this business. And I think we're looking at, and we look at our cost of capital on a holistic basis, what's our access to kind of straight debt markets? How about convertible notes, prefs, ATMs, Bitcoin-backed lines of credit, selling the HODL, and we assess this across the entire spectrum of opportunities that we have. And what we've come to is I think that there was a real, reason that you wanted to go as fast as you could to take space in this business over the last couple of years. So, I think that, there was dilution in the business, but, we're very confident that it was accretive dilution. They went from 5x hash to 50. They went over 5% of the network, et cetera. But now you're moving into a period where the opportunity set is maybe not quite as clear. And so it's not a growth at all costs or growth at kind of most costs kind of model. It's a growth at reasonable cost, a kind of a GARPy growth at a reasonable price model. So, that to me is when we're talking about the HODL, it's, hey, we have X amount of salaries, electricity bills, et cetera, to keep the business going on a monthly basis.
Yeah.
We're selling the HODL to cover that. Now you can look at, hey, should we also sell a little bit more so we can pay down our line of credit so that we can be opportunistic if there's another kind of opportunistic M&A opportunity? Should we build up a little bit of a cash balance so that we can take it in? We can talk about take advantage of kind of basis trades and other things, other kind of financial opportunities. Should we, what can we do? So I think that first and foremost, it's cover the OpEx, which is the ongoing cost of the business. Second, it's how do you fund the CapEx? You saw that we have up to kind of another 10x a hash. That has to be funded. That can be funded either by borrowing via the line of credit, issuing debt via the convertible, or selling HODL. And then the last is that you want to be a responsible financial steward, and you want to manage the business on a net debt basis. So you want to always be liquid and able to pay that down, and you want to pay it down when you can, not when you have to, right? So that's the HODL strategy.
The Gourd Show is sponsored by Ellipsis Labs, who I've been following for 3 years now. They're one of the strongest teams I know in crypto. Ellipsis Labs is a small engineering team with a flat structure. They build complex systems, primarily in Rust. For engineers who like challenges, here's the kind of problem they solve. A layer 2 blockchain needs to maintain 100 million accounts and generate a state root after each transaction batch. the root must be built within 50 milliseconds. How would you design a system to ensure the root construction is fast enough? High-performance challenges are core to Ellipsis Labs' mission as they build modern crypto finance. They believe finance needs more than an upgrade. It needs a complete rewrite. The success of their first product, Phoenix V1, speaks for itself, doing over $70 billion in organic trading volume. Now, Ellipsis Labs is building Atlas, the blockchain purpose-built for verifiable finance. I know this team personally, and I like them because they're unique in the crypto space. They have a long-term focus, they work in person from their New York City headquarters, and they're here to build products that fundamentally change the world of finance. If you want to learn more about their open roles, go to ellipsislabs.xyz/careers. We have this massive mania around DATs right now, and DATs are effectively pure financial engineering. You guys have actual ASICs on the ground. You are the ones building Bitcoin blocks, right? It is a different line of business. With that said, given this mania around DAT, I assume there is outside influence to increase financial engineering. How much do you think, and you guys are a public company too, so I'm not saying that, you've been, pushed to become, Ponzi upon Ponzi or anything like that, but given this new sort of asset class, you guys are public, you have Wall Street analysts covering, how do they look at a Bitcoin miner that HODL some and may engage in some financial engineering, right, to sort of maximize the utility of their balance sheet and then also their actual hard physical business, right, versus one of these DATs, right? Like, have you felt personally motivated at all to I say personally, has the business felt motivated to kind of increasingly lever up, even though if it's not in the exact same capacity?
Yeah. Look, let me touch on the DAT and kind of general strategy kind of briefly, and then let's talk about what we're doing and how we think about it, right? So I'm with you. I'm of two minds because on the one hand, so earlier this year when really things really started to take off in last year, kind of MicroStrategy, I realized I didn't understand it to the degree that I needed to understand it. And so I went and read every 8K, every 10Q, every release. I watched every podcast with Ben Workman. I took notes and I really kind of went back to the drawing board on kind of understanding this. And I came to the conclusion that Saylor really was onto something, that volatility is vitality, has real meaning, that arbitraging across capital markets is a viable and reasonably sustainable strategy, at least for a first mover, and that there's a real there. Okay, so I think that's very interesting. I think that to me the two key insights were, you do your CFA and you learn that risk is volatility. And Howard Marks talks about this all the time. Like, risk isn't volatility. Risk is the chance of permanent loss, right? But all of our models in finance are based on this idea that you square volatility and you get your standard deviation and you figure out kind of how much things are going to move over any period, and that's risk. And really what it was is that there are these instruments and there are these specialized investors in convertible bonds who benefit from the volatility because they take the bond and they get it at a little bit of, just like an IPO, they get it at kind of a good price going in. It allows them to set their hedge, and basically they don't care if it goes up or down, because as it reaches that conversion price, they're selling into that conversion price to the point where they're 100% hedged by the time they hit that conversion price. And so that means that they're selling on the way up. Now, what are they doing? So what are they doing on the way down? Now they're short at the top. If it goes back down, well, you can buy that hedge back. So you're long the equity. And so you're buying low and you're selling high, and you're buying low and you're selling high. And so you're just the kind of the fundamental dynamics of how this specialized investor class manages their risk is conducive to a highly volatile instrument. Okay, great. So that's really interesting. The second, I think, key insight was that, and I've thought about this, but Saylor thought about it deeper and exploited it to $1 billion, to the tune of $1 billion, which is that you have all these mandates, and he talks about it all the time. Yep. And I think people see it and they don't really understand what he's onto. He says, hey, okay, there's there's $300 billion of dedicated commodities investors. There's $3 trillion of dedicated credit investors. You're just talking about a little keyhole and a big river that can go through that. And that is an idea that I think we are at the beginning of that, right? The mandates across pension, and this is one of the biggest things that I've learned in the seat that I'm at now, is that it's all about structural alpha, right? ERISA investors, which is a managing pension plan assets, have certain structural parts of their mandate that they have to follow.
Yeah.
Credit investors and equity investors and hybrid. And so all of that. So bridging the gap between those pools of capital, bringing them into a Bitcoin linked instrument and flipping the script on, actually you can turn what has traditionally been modeled as a risk into an asset in Bitcoin financial markets, I think was just an incredible, brilliant insight. And I still think it's underappreciated, despite the fact that it's $100 billion company. Okay. Now let's talk about the long tail. There's a lot of kind of fast follow. There's a lot of undifferentiated. There's a lot of money chasing things. So, one company, I think that the Nakamotos of the world, the David Baileys, are really interesting, because I think that they have a model where they go, okay, what we've seen is that you have this capital market arbitrage. And what I've realized is that you're going to have it. There's a fractal to that. It's also in Peru and Ecuador and Japan and Norway and whatever, because each of these different markets, the capital markets regulators have slightly different requirements. Like, you don't have an options chain in Japan. You don't really have ATMs in Europe. So you do this kind of like sponsored issuance thing, but it's not the most efficient. And so if you can go in there and you can basically take this and you can put it into all of these different kind of domiciles, whether it be an industry domicile or a geographic domicile, ideally both, you can exploit those arbitrages across a whole fractal of different markets. That's interesting. And I think Dylan LeClaire and Simon Gurovich are doing that at Metaplanet. I think they found that in Japan, and they did it to the tune of multi-billions of dollars. So wonderful. Where I worry is that, like any capital market cycle, a good idea is, it's like the David Einhorn, like, one donut is great, 3 donuts pretty good, but I'm starting to get a stomach ache. 10 donuts too much, and you're always going to see this, right? Look, every market cycle turns because why? Because one, there's demand finally meets supply. So in equity markets, you get a massive issuance of IP. Last time we did it via SPACs, but it's always IP. It's always equity issuance, because you can always issue more equity, right? So you can issue more equity, whether it's at an individual company level, whether it's at kind of an industry level, whether it's at an economy-wide level. So you're always going to find that. And so, I worry that if the idea is just there is a multiple on issuing equity to buy Bitcoin, I'm pretty confident that that's going to collapse at some point in time. Where I do think there's a sustainability is that I think that there is more and bigger sustainable arbitrages across capital pools and across kind of structural, regulatory, and geographic environments. So what does that mean for us? Please, and let me pass it back to you for a second before we kind of go into that.
I guess I'm like, I was just thinking, the reason. Sorry, I didn't give the last question I asked wasn't the most articulate, but really, I guess the point I was making was, it's interesting now to observe these stats and see that from the outside, and it's a bit reductive, but from the outside, it's pure financial engineering, and compare that to something like a Cleanspark or a miner that does actually produce something real and has genuine hardware. And I guess I'm just interested, is the market over indexing in your opinion? I think given, where you work, you would probably say yes. Are they kind of over indexing on this? Like, we can play this Ponzi game out in perpetuity versus maybe Cleanspark and some of the miners, the public miners, are saying, look, like, we have a real business to back this. And in the long run, let's say that Michael Saylor's sort of neobank theory plays out in the sense that there are ways to generate real returns as a function of holding a massive amount of Bitcoin. That may work for something like MicroStrategy that does have sort of this, I don't want to say winner take all, but massive economies of scale there, right? And we already see this with the rates that they access in markets, right? Like they always have the most preferable terms. That may work for something like MicroStrategy, but is the way that CleanSpark thinks about positioning this more like, look, we have something real behind this. A lot of these don't. And when this premium collapses, right, like both literally and figuratively, we have a real business behind this, as opposed to, the nth Ponzi. Is this sort of where you're trying to guide a mining business, if you will?
I promise, for anybody watching, I promise we didn't talk about this before, but look, I'm never going to say no to talking my book, but like, I appreciate the setup because yes, that is exactly the thesis, right? And I think that's what's been super underappreciated.
Yeah.
We kind of talked about different as we were just kind of, showing up in the green room, we were talking just a little bit about where the mining cycle has been in the past. But to me, it's also that there's a cycle to the entire mining playbook, which is you want to run as fast as you can to get as much Bitcoin on the balance sheet as you can, because this is a pristine collateral asset. It's a global emerging monetary alternative, and it's a rapidly developing financial market. Okay. You also have a power, industrial, real things that hurt when you drop them on your foot kind of side of the business, which is also growing in value. And then you go, okay, now I have an industrial kind of, I have kind of an energy and industrial side of the business. I have a commodity production side of the business, but that commodity is the hardest and best, most pristine collateral ever created in the world. And now what I have is a rapidly developing financial market around this global emerging monetary alternative. So what do I do with that, right? And so to me, that's been super underappreciated. And I think it's fair that I think it can be fair that the market has maybe not fully grokked or understood where we're going and how we're thinking about this. But like, it takes, and I'm not trying to like come up with excuses, but if you're doing things in a mature, long-term, institutional and risk-adjusted way, it takes a while. So we started talking about this a year ago now. So I started at the end of October. We started kind of talking about what this would be and what it would mean at that point in time, right? So I show up, first things first, it's talk to everybody on the street. So I had, 50 meetings in 2 weeks. It was back to back to back to back to back. Just, who are the traders? Who are the custodians? Who are the consultants? Just all the personalities, all the people, what is the opportunity set? What can we do? So then and then kind of concurrent with that, it was designing the philosophy around really understanding the business. Okay, so we have the commodity, we have the kind of the Bitcoin production side, we have the energy side, and then what does it look like? So you take Econ 101, right? We go into Econ 101 and everybody says, okay, they show you two curves. As price goes up, demand goes down, right? As supply goes up, demand goes down. Well, Bitcoin's not like that. As price goes up, demand goes up, right? And so you have these inherent kind of Veblen good characteristics within this business. And then you have a business, which we talked about, has three kind of layers of multiples on the leverage to that. And so what you're naturally in this opportunity set where you go, okay, so you're telling me, so and there's what's called kind of it's called the volatility smile essentially, or you can look at kind of riskies, right? So for an equally out of the money call and put, what is the vol? And the vol is basically it's the plug for price. It's the volatility and the expected kind of movement around the option, but essentially derivative traders use about it to talk about it as the price, right? And so in Bitcoin, in most markets, puts trade richer than calls. And the reason is because the same reason you buy home insurance, right? It's a lot worse to lose $1 than it is to make $1, in behavioral psychology. And quite frankly, just in kind of Lindy ways of a business, right? If you go, you can always keep rolling if you're at the table, but if you go broke, you got to leave the casino, right? So usually you got to pay for insurance. In Bitcoin, the insurance is missing out to the upside. So we're long the HODL, right? We're long the future production. We're long the ASICs. We're long the energy. We're long the growth multiple on the business. What can we do with that to take advantage of those and create a structural ballast against that cycle for ourselves? And so the very easy, I like going to examples. Super simple. We didn't invent fire here. We're not the first ones to do it. I just think it happens to fit our business like a glove and almost better than most other businesses I've even seen. It's just call overriding, right? It's very simple for us to say, hey, we have X amount, we have a month of cash in the bank. Do we go to 2 months? Do we go to 3 weeks kind of thing? But I can manage around that cash balance on that outgoing basis. And that allows me the optionality to sell call overrights into the market. And so I'm benefiting from this call overright. And so things go down great. I kept a little bit of premium. I can write it again. I can write it again. Those at the money kind of yields, even despite the fact that the vol market has just really contracted and really come into what looks much more like an institutional kind of grade asset than what it was looking like, even a year ago. Those are still great kind of premiums that you're getting. And so I'm doing that call overriding, and that really fits because then I'm creating this natural offset. So great. We go up 20% in Bitcoin. I'm happy to sell at 125, 130. I have calls up to 148, right? So great. We get up to 148K in the next couple of weeks. Honestly, I'm happy to sell there. We're going to pay our salaries, going to pay down some debt. We get to be opportunistic. We're not paying the interest rate out. So we have all these levers in the business all over the place that allow us to take advantage of that, right? So I think that there's that side of things. Now, I'm talking more about what you talked about on the kind of going further out, like what is super, like, to me, where I think, I think some companies have really, we talked about MicroStrategy. Obviously, they've really focused on the capital market side. That's interesting. And there are other treasuries that have really focused on kind of the leverage on the HODL side. What we have is an ability to kind of set these natural offsets in our business. And we also have an ability to kind of, if you have a mining business, you're bringing in $800 million a year in revenue. Yeah, sometimes margins are great. Sometimes they're not as great. But as long as you're kind of profitable throughout the cycle, that's access to capital markets. That's access to cheap capital, right? And so you have that side of things, which I think really kind of sets up the business well. I think you have the natural kind of ballast that you can add with some of these kind of call overriding strategies. Let's say you get called out of that call. Okay, well, there's other characteristics that you see in this cycle, right? So as FOMO increases, let's say you get called called away. Generally, you're going to see vols are generally increasing at that time. Not always, but generally vols are increasing. FOMO's increasing. The basis is increasing. The basis is the difference between the futures and the spot price. And what that means is basically, if you're a hedge fund, you have limited capital. You have $1 billion, but in order to get to those 20% returns, you need to be trading like you have $2 billion or $3 billion, right? And so you can do that by going into the futures market. And the futures market is basically saying it's the March future. So, today Bitcoin's trading spot on Coinbase, but you go to the CME and you can trade the March future. And the March future is trading about 5-6% ahead of where spot is. And that's telling you that the market is assuming that the market is pricing in a 5 or 6% increase between now and March. That's actually a little bit rich. It's more on an annualized basis right now, but you get the point, right? Talked about the FOMO market. So, one calls richer than puts. So that's one aspect of it. We get to take advantage of that because we're long the production, we're long the HODL, et cetera, right? Second is we get called away. Great. Now we're paying down the line of credit, which at prices that if we took it, we funded the business, we invested in growth, we got more Bitcoin, we sold it at a premium, and we're paying back the debt. Great. That's a great cycle to be in, right? Now you're holding a bunch of cash. Maybe you're holding more cash than you need. Now I say, hey, okay, I could put this in the bank for 4.25 and maybe even a little bit less, or everybody's going nuts. Basis, 2 weeks ago when we got back to all-time highs, basis went back above into that kind of 11 to 12% range. So you could basically lock in 12% on your money. What you do is you sell the future and you go long the spot, right? And you basically just collapse those trades. So you say, hey, I'll take a month. I'll put this into a CD for a month, 2 months, 3 months, 6 months, and you basically take that delta neutral interest rate, essentially, right? And so there's these suite of things that I think that we can do. And I think that those are great examples of kind of how we're thinking about this from an institutional risk management perspective, where we're thinking about how do we add a little bit of ballast into the business, right? That takes kind of the natural cycles that we're in. Hey, you got to have a view. I didn't trip, fall, and land here. I want to be in Bitcoin. I believe it is an asset class. My personal, professional, and spiritual capital are invested in this space. But I still think that if you want to survive over a cycle, you want to take advantage of, you want to be a structural seller when you go higher, and you want to be a structural buyer when you go lower. And I think we're trying to add that into the business. Now, what are some other things that we can do that we can expand into? So when we talked about kind of how we got to this digital asset management kind of Bitcoin Treasury thing, I think I came up with a philosophy, and I presented it. I presented it to management. We workshopped it together, and this is really kind of where we landed, which is there's 3 North Stars, right? First is preservation of capital. Don't die, right? Second is enhanced cash management. So that's, can I get a little bit of premium out by, instead of doing a limit order, like we have to, every month we have $30 million of expenses. So I can set a limit order in the market, or I can do these series of call options, maybe take a little bit of premium out of it, whatever. So trying to enhance, maybe do the basis trade. Maybe I want to sell. I know that I need the cash, but I don't need it till the end of the month. I'm happy to sell here, but I can get 2-3% more going in the future. Just being a little bit more methodical about that. How do I do that? And then the last is kind of the yield generation side, which I think is more out of the money calls. I think it's kind of trading a two-way book. I think it's some of those other things, and things that I think will kind of continue to evolve as the opportunity set in the market evolves. But there's also, we've also found opportunities to do things that I don't think we would have been set up to do a year ago. So we talked about in our earnings report that we'd gotten an option via one of our suppliers. And essentially, we were looking at making a big ASIC purchase in April, right at the kind of end of March, beginning of April. It was right kind of during peak tariff uncertainty. The producers and manufacturers didn't know what was going on. In the past, they've done kind of coupons or rebates. They've kind of moving away from that. And so essentially what the arrangement was that we pay for the ASIC, we pay in Bitcoin. We get a 115% rate on that Bitcoin. So essentially you're getting it works out to be about 14.5% discount if you're thinking about it that way, because going the other way, going down. So it's like you need 100% to go up. If you go down 50%, you got to go up 100%. So, but yeah, you can think about it as getting about 15%, about a 15% kind of premium on that cash, right? So you pay in Bitcoin, you pay at 115%. And then you get a call option to buy that Bitcoin back. So in 6 months, if that Bitcoin is trading higher than where we paid at 115%. If we go up 25%, I can buy back, I can give cash to satisfy that cash obligation, buy back my Bitcoin, and kind of get a double dip on that, right? So because we have this institutional trading desk and this institutional setup, we've gone through the interview process. We went through the RFPs. We negotiated the ISDAs. We signed up the counterparties. We've worked on we've done the accounting, internal controls, worked on the movement, kind of done all of this setup. We were able to look at this and go, hey, okay, so we got up to 118, 120, and we said, hey, okay, operationally it would be very complex to go. It's an American option, but operationally it would be very complex to go raise the cash right now, fully exercise the option. And I don't necessarily know if I want to do it in one go, because things can move and we're a business and et cetera. So, but what I can do is I can hedge this option out, because all I need to do now is sell a call option against it. I'm long a call option here. I can sell a call option here, and I can lock in that premium, right? And so we were able to lock in. So as we got into kind of those new highs, we were able to kind of slowly and methodically over a couple of weeks hedge that risk out. And so now we've locked in, we've locked that in, and that gives us a lot of optionality. So now, and I don't know where we are 40, 50 minutes in, but walking in, we were back down to 109,500. And so we were able to kind of hedge that out in kind of the mid teens. We're back down, back down below where actually we're long that call option. Theoretically, we could trade around it. We could buy we've sold the call option. We could buy it back if we think it's going to go higher, et cetera. Or we could sit on the, pretty significant premium that we've generated kind of doing that. Now, I want to be clear. That's not an opportunity that's going to be available every quarter, right? So the guidance that you heard from Gary on what we can do and how we can do this, that's not kind of, this is going to be, it's going to look like a big win. And then it's going to, and there's going to maybe, you could see some maybe kind of cycles within this. But what I think is it's just a really good example of what are the opportunity sets that an institutional grade Bitcoin Treasury desk can afford an organization over a cycle that takes advantage of our world-class mining operations. We have that opportunity because Taylor Monig and Scott Garrison and Brad Otis and all the way down the line. And we always say we work for the techs, because if the machines aren't running, there's no Bitcoin coming in, right? So I was in Sandersville, Georgia last week, getting to meet the team, and it's so cheesy, but it's truly like the honor of my lifetime is to get to be a part of.
Is this like the nuclear thing?
This was not the nuclear thing. I went to our sites and we kind of had a bus tour because we were doing some other stuff. But it's just, there's 8 buildings. There's 3 football. They're 2 or 3 football fields long. They're 25, 30 feet high, and there's 8 of them. And it's just an astonishing thing, right? So that's the business that they've built. That affords this opportunity set as a natural part of kind of that business. And then what we're building here on the digital asset management side allows us to optimize and take advantage of that. So this is what I'm trying to say. We're not building a hedge fund, man. This is not supposed to be a hedge fund, right? This is not supposed to be a come in, gunslinging, trying to make 20% on our money. This is taking, hey, we have cycles in the business on the OpEx side. We have cycles in the business on the CapEx side. How do we, and there are these, let's recognize what are the structural setups in Bitcoin capital markets? What are the structural setups in our capital cycles? How do we marry those to not have them to turn them, because our revenue asset is Bitcoin and our expense asset is still USD. To the extent that we can, let's turn that. If we can't turn that from a liability to an asset, let's at least neutralize it as a liability. Can we just optimize marginally? Can we get 3, 4, 5% more out of our money? Can we sell 3, 4, 5% higher? Can we buy 3, 4, 5% lower? Can we monetize something 6 months earlier that brings that cash in? And to me, that's the cycle, right? The difficulty adjustment does the rest. You get to be a big enough portion of the network. You have economies of scale on your operations. You have economies of scale in the network. You have economies of scale on your power, and now you can have economies of scale and take advantage. And 3, 4, 5% in this business over a cycle. That's the difference between being being top miner and thinking about, which was me in December of 2021 or 2022. I was sitting at dinner with my wife going, what the heck am I doing here? Why am I? It's tough. It's tough out there, man. Yeah. And so, and I think that, and we've all been there. Everybody in this business has been there. But what we want to do is we want to take advantage. So it's not meant to be. Just want to be clear. There's discretion in what we're doing, but it fundamentally is about a structural. What is the structural alpha in our business? I talked about this when I talk about the philosophy, and then I will shut up. I promise. There's 5 ways to get alpha, right? Okay. 1, information. I can have better information than somebody else. 2, analysis. I take the same information and I analyze it better, right? 3, behavioral. I just have better temperament, right? You freak out. I don't. Okay. 4 is technology. I have better pipes. You see this with kind of HFT, et cetera. And 5 is structural. And that's really we have pieces of all the other 4, but the 5th is really the most interesting, I think, for us, because we sit in that kind of, what has been, I think, thought of as a liability in the past, which is that great, when you're up, you're really up, but you're really leveraged that cycle. There's ways to just start to structurally take advantage of that.
Okay, this has been fantastic, and you've focused a lot on the capital market side, which is why we brought you on, so that's good. I know you're quite knowledgeable just about this entire industry, so I'm just going to pick your brain now on some Bitcoin mining topics in general, since, like I said, I don't typically do Bitcoin mining stuff. I leave that to Will, who has the mining pod. It's much easier.
Love Will.
I read, so in the process of preparing for this, I read, and you quote me if I'm entirely wrong, because I think I probably sourced this from some version of AI, that your cost to mine a Bitcoin is around $35,000. Is that correct?
So I don't know if that was 2 quarters ago or this quarter. I think it's in that 35 to 45K range.
Okay.
It's without depreciation. So, I don't have the exact number off the top of my head. So I don't
no
want
worries.
to quote on it. Yeah.
No worries. Anything you respond to that, as long as you didn't say it cost us $108,000 to mine a Bitcoin, I had a follow-up question, which is, those are pretty good margins. What does that actually mean in practice? Like, explain $35,000 to mine a Bitcoin to somebody who has essentially no understanding of Bitcoin mining. What does that mean? Does that mean energy cost? Is that blending the average cost of ASICs? Is that, like, explain what $35,000 means? Just like directly.
Yeah. And again, I love to be in Bitcoin mining because I get to put my boots on and go to Georgia and play and play it on TV sometimes. But let's be clear, I'm a computer jockey. But that being said, to address that, my best understanding, and I really want to be careful to not give misinformation. My understanding is generally that is the electricity cost. It's the direct cost of operation. So your site techs, electricians, lease and rent on the site, equipment. There's all these kind of different things that go into that. So if you go to the site, everything you see going on there is the cost to mine Bitcoin, right? I think that different companies look at it different ways. We always try to be as transparent as possible. We add in kind of electricity. We add in our tariffs, kind of fully baked kind of cost of electricity. Different people strip things out differently, et cetera.
Yeah.
We try to be there. I think where it doesn't necessarily cover. I don't know if it covers, like, if it counts for like insurance, like SG&A, like that kind of stuff. I'm a big fan of Penny Ether on Twitter. He's hard on everybody, which is what I appreciate about him. And I know he does these great breakdowns. But yeah, from the direct cost to mine, I believe it's mostly electricity, like salaries, like on the site, equipment, leasing, that kind of stuff. Yeah.
So
it's basically like, if everything went to zero tomorrow, can you still get that Bitcoin out of the ground, kind of thing, versus are you going to be able to kind of continue growing the business, doing all the rest of that stuff, versus does the big, if the tech is not there, the Bitcoin's not, thing breaks, Bitcoin's not coming out. Whereas, I don't know if we know, are we quite frankly, are we expanding in digital asset management? Are we thinking about optimizing the Treasury? Like all of that kind of stuff.
Well, I guess those are like sort of ancillary, and it's, I mean, there's like so many variables there that you would assume that when you talk about like the marginal cost of production for a company, that they're not including, the cost for a Bloomberg terminal for their digital asset treasury guy, right? So that's my assumption as well. But
those things are important, but they're important to optimization, not to getting the Bitcoin out of the ground.
Well, the interesting part about that, though, is, let's say 35,000, 45,000, whatever it is, those relative to the price of Bitcoin, that's like very, very good margins. And the reason I'm asking you this, and like sort of the leading question here is, there's, and this has been going on since the inception of Bitcoin, but there's this notion that, Bitcoin miners are inevitably going to fail in the long run, on the grounds that, as marginal cost, converges on marginal price over the long run, that's just not sustainable businesses. And, the counter has always been, well, it's a commodity business, and you can look at something like gold and see a lot of very interesting corollaries. It costs a lot of money to get gold out of the ground. The margins are, sometimes very, very thin for massive companies. Some of the smaller gold miners, which is like 80%, the long tail of gold miners is roughly 80%. Their margins can be much bigger because they can go to smaller sites. They can go and access places that larger miners won't. This has been what, at least when people tell me, right, Bitcoin's going to die as a function of all the miners going out of business, I say, well, look, this is what gold looks like. I'm not going to say that Bitcoin mining is not going to die, but I think there's some interesting parallels to draw. How do you look at this? Like, how do you look at the state and health of Bitcoin mining as just an industry? Like, zooming out now.
I'll be very honest with you. You don't get into this business if you want it easy. Okay, you gotta have a couple screws loose.
Yeah.
And it's tough. It's tough out there. But you got to have a view. And my view was Harry really helped me understand this because I was really kind of a classic finance guy 4 years ago. And I was like, look, it's a commodity business. The margins are going to go to zero. You're going to get out-competed out. Yeah. And like, that's true. And the difficulty adjustment, economies of scale, and ancillary power services, ancillary financial, services opportunities, I think are all real interesting and sustainable paths to move forward. Right. I think that Bitcoin mining, I think that one of the reasons that Cleanspark was so strategically interested in getting to the competitive position that they are now is that this business is a lot different in the top 5 than it is in the bottom 5, right?
Yeah.
You're not mining the same Bitcoin. And so if you can stay ahead on power costs, people costs, leverage, for instance, the option that we had with our supplier, we have a large scale relationship with them. We buy hundreds of millions of dollars of equipment. You've seen many miners start to pivot away from a pure play kind of Bitcoin mining perspective. That means that if they want to keep their allocation at the fab, and they want to continue to sell machines, then they're going to need to work with their biggest producers. So you have pricing power on the equipment. You have pricing power on the power side. You have economies of scale on the operations. It goes all the way down to like, did a bus tour with our insurance, right? The total size of our operation is increasing, but as the insurance, as we educate them, they start to understand the business better. We show them our sites. We have top flight cybersecurity, on-site security, all of these types of things that we can do at an institutional scale. This just drives down the cost of capital across an entire organization in a way that I do believe will allow you to stay competitive, even as we run it. Like, look, it's no secret that block fees are very, very low. And it's no secret that there's a halving in 2 years. Okay. That being said, I think that this is a great business that at the scale and competitive position that we have, that you have that opportunity set over time. I do believe that we are evolving and that the next evolution is going to be, okay. I think our CEO, Matt Schultz, talked about this at SALT last week. He talked about we've been talking about monetizing hash rate. Now we're talking about monetizing megawatts. And I think that that's true. And I just think it's going one level up. Great. Our models still often say, okay, fastest to market, cheapest to build, fastest payback, most upside, Bitcoin mining. Great. But we have megawatts. We don't just have Bitcoin miners, right? We have megawatts. Yeah. So I think that there's that aspect of things. I think there is the ancillary services side of things. I think, and I really, and that's really on that side of things. I'm in my lane. My lane is capital markets and how is that going to develop? And so I think that you can drive just a little bit more out of that, right? And lastly, Gord, it's like you mine the Bitcoin, you mine it at 50K. And hope is not a strategy, right? And that's what we're trying to do here is we're trying to design an institutional hedging program that hope is not a strategy. But you mine it at 50K, you sell a covered call at 65K, you sell at 65K, your margin looks a lot different at 65K than it looked at 50K, and you're benefiting from that kind of natural volatility in industry. Yeah. So I just think that suite of things is going to allow us to, again, keep keep discovering and finding new avenues to drive marginal profitability over the cycle.
Like, I think this is probably just Twitter, right? But there's like just constant FUD about security budget and Bitcoin mining, and it's all, you know, in the future. So we really can't push back apart from just some, you know, notions of how other things work and how we think this business evolves. But it does seem to me that I don't know that people realize that Bitcoin miners mine Bitcoin at 50% of what they can sell it for. Like, I'm not sure that really resonates. I mean, and I think that the reason I was saying this is because, you know, from a lot of my understanding about gold mining, I mean, there are some very, very large gold miners, and they have bottom line for 5% margins, right? Like, and that would be, I say 4 to 5% margins, in the sense that, like, my understanding is they're mining an ounce of gold at $3,300 and they're selling it for $3,500. It's now there's still a fairly large, you know, gap in Bitcoin mining. Obviously, over time, right, we assume that this converges. That again, this is the premise of a commodity business. I guess the follow up that I would have is: do you foresee the future of Bitcoin mining? Like, one of the most compelling, maybe it's just because I'm biased and I want this to be true, but one of the most compelling arguments is that the future of Bitcoin mining is a lot of Bitcoin miners are probably not going to be first and foremost Bitcoin miners. They're going to be energy companies. They're going to be hardware companies that, in their off time, right? This is the concept of sort of like intermittent demand, and what we see in Texas already in practice. So there is some evidence where when the demand is there to mine Bitcoin, they mine Bitcoin, and the other times they run AI and power people's homes. Like, is there validity behind this, or am I like, I really need this to work because my bags are 95% dependent on it, right?
I'm dragging my bags in here, man.
Exactly.
Them in, right?
No, me too.
I got you. Like I said, like I couldn't be longer in this space, right?
Yeah.
Like, yes, right? Like, it's all of the above. And again, I really try not to be too kitsch. And so it's really easy to say, like, Berkshire Hathaway, Apollo, but that is how to me, my model is Standard Oil, right? Okay, right. You roll up all the little kind of whaling kind of oil stuff. You standardize the quality around that. Then you own, then you kind of design the rail car. So you have the efficiency moving things between them. And then you have the trade financing side. Then you have the distribution side. And to me, it's that, okay, great. The Bitcoin business, I think, is always I think it's always going to be there, and I think it's going to be profitable at scale for all the reasons we talked about. But that is going to ultimately allow you to be a very large revenue item, maybe even as margins compress, but it's a very large revenue item. What does that give you? It gives you access to capital markets, lets you service debts, it gives you opportunity sets, it lets you fund new opportunities, right? And then you're going to have, and so that creates the float, right? That creates the thing. Then that's just actually, that would even be one step in. That's the commodity production side. You have the energy and infrastructure side, which is a mega theme right now. And I really don't think that's changing. We have, it's clear to me that even if we're off by half on our projections of where we need to go on energy, on energy production in the US, we need to increase somewhere between 50% to 300% over the next 10 years. Okay. So we're going up, we're going somewhere on that. Okay. So you have the energy side and infrastructure side. You have the kind of the float, which is like, even if margins compress, you're just driving enough top line that it continues to give you access to capital in a way that is differentiated and cheaper. And then you have the financial services side. And I think the kind of the Bitcoin banking side, which is great. It doesn't happen overnight, but we're seeing, our Bitcoin, like, we're using Bitcoin we're using Bitcoin to collateralize our loan with Coinbase. We're taking in dollars. Those dollars are funding new growth. And so that's one product, but there's all of these other products that I'm really excited to talk about more over time. But, like, trust me, we're looking at things, we're thinking about things, we're developing things. The future of structured products is maybe a bad word, but let's talk about the proliferation of different things you can do with Bitcoin. Bitcoin is a pristine collateral asset. It's a zero counterparty, pristine collateral, global, decentralized, permissionless, take it across the border in your pocket asset. It trades 24/7 and you can liquidate it on weekends. Okay. That to me is a perfect asset to serve as a collateral asset, right? So the things that you can do with that as you add that in, and you don't need to reinvent fire. The kind of anecdote I always use is everybody looks at when Mark Andreessen left University of Illinois, and then they created Netscape. And they always use that anecdote of they went into a room, they coded all night for 2 months, they ate pizza, and they came out with Netscape. And what people don't talk about is that the reason that they were able to do that is because he'd spent 2, 3, 4 years at University of Illinois developing all the concepts, doing the hard work, whiteboarding, walking around, doing the computer science stuff. He left, he didn't have the IP, he had to recreate it, but it was all in his head. And so you go into this room for 4 weeks and you come out with a product. And I think you can do that in Bitcoin, which is that you don't need to invent fire here. You can adapt and adopt these. Look, Bitcoin, the promise of Bitcoin is that it's censorship resistant, anti-authoritarian, it's immutable, it's verifiable, it's verifiably scarce, all of these things. We don't want to just create the same BS cycles on this new financial instrument, but credit's been around for 3,000 years. It's not like, exchange, monetary exchange. So I think that there's ways to adapt and adopt some of those types of products that we're always going to be part of this. Great. Let's take these products, which help people, help human flourishing, right? Like what is at the heart of the United States economy? Why is it the best economy in the world? Because you can make things and you can price things, right? You make things because we have access to reliable power, and you can price things because we have access to deep capital markets and strong contract law, right? And so we can take that, and those are things that allow people to think into the future, to bring forward production, to finance growth, hopefully in a responsible, staid, verifiable way, that if you can't just go benefit from being one of 13 banks that has access to the Fed window, but it does, like, there's a big difference to me between benefiting from the Cantillon effect of being kind of a Fed, a Fed kind of Fed window participant versus building a hybrid credit product and access to these types of things that's priced in Bitcoin at a Bitcoin interest rate and a Bitcoin hurdle rate. We don't know what the hurdle rate is yet for Bitcoin. And that's MicroStrategy is doing something very interesting. They're trying to extrapolate a yield curve on Bitcoin. And I think we're going to take that outside of a single company specific thing, and we're going to bring that across the entire market. And I would say that's, look, I'm a nerd, but that's very exciting to me. And it's not just to reinvent the wheel of it. It's meant to, there's nothing inherently wrong with credit. What's wrong with credit is if it's mispriced and misallocated, right? And that to me is we have an opportunity to kind of build some very interesting new things that can adapt and adopt traditional financial instruments onto this global emerging monetary alternative and this immutable, pristine collateral.
That's about as inspiring a way to end as I can think of. So
I didn't know credit markets could get that, but they excite me. They do. We're in a cool space where it's fun. It's every day is a little nuts, right? But it's a fun space.
All right. Well, thank you so much for coming on. It's been fantastic.
Thank you for letting me talk over you all the time. Appreciate it.
No, it was great. That's what the audience wants to hear. They want to hear just stream of consciousness rambling. That's ideal. So I appreciate it.
Thank you.
Thank you.